Well, the major indices are looking to open higher on the S&P 500 with fractional gains pre-market as investors navigate everything from private payrolls data to a slew of corporate results. And joining me now with more is Mark Newton. He's head of technical strategy at Fundstrat. Mark, it's good to have you on the show this morning.
Thanks, Kristen. Great to be here.
How is the market looking to you?
Well, look, equities have held up in pretty resilient fashion, despite the fact that we've seen pretty rampant sector rotation since the beginning of the year. It hasn't been technology that's been working well, and it's really been energy, materials, even consumer staples. There are three reasons that I think investors really need to be prepared for potential volatility in the months ahead. And the first is that the recent deterioration we've seen in software very well could start to metastasize to other parts of technology, like semiconductors and even some of the storage stocks that have really gone sky high, the Western Digitals and the Seagates of the world. It's not unusual to see the areas that have seen real froth start to come back to life. We saw that in cryptocurrencies, it spread to precious metals lately, and now more recently software. So I think investors need to be prepared for that also to happen. The second reason is that, heading into the second year of a second term of a presidency historically has not been kind to the market. We saw that during Truman, Eisenhower, even more recently, Obama, Clinton, George W. Bush. So normally when you get to that second term, that midterm election year, you tend to see volatility. And, the third reason is a new change in Fed leadership is going to be really, really important. I think that historically the max drawdown has been about 17% when you look over Powell, Yellen, Bernanke, and, and Greenspan. And so Greenspan, of course, presided over the '87 market crash. So I think that, honestly, for the investment public that sort of parses over every word that we see from the Fed governor to now have somebody like Warsh step in where we're not certain of what his communication style is, what his leadership is, what his message will be, what the path of the rate cuts will be. And my thinking is the markets are likely going to experience some volatility that coincides with previous times when a new Fed leader has stepped in.
So you laid out there how we could see the volatility play out. Mark, what does this mean? A pullback perhaps of 5%, 10%?
Yeah, I don't think it's imminent, but I do suspect that by the month of March, we are going to start to turn down, and that means probably 15 to 20%, and that really is between March and October of this year. So I don't sense we go into a bear market per se, at least by the media's definition, but I think that in general, we're going to need to reset and show some consolidation on many of these high flyer AI names where, many companies are still struggling to really realize profits on their investments in AI, and we're just not certain how that's going to materialize. So many of them have gotten very overbought. Technology still in a major longer-term bull market, I would argue, but after 2 straight years of 20% returns and then 17% last year, we likely need to reset that. And this is the year likely that it happens, coinciding with a lot of really prominent cycles that suggest that markets need to pull back.
And you've laid out some of those cycles. Any other ones our viewers should know about?
Well, the most important for the entire stock market's really the 41-month cycle. It lasts about 180 weeks by Edward Dewey. It's presided over the majority of the larger sell-offs over the last 100 years. And so it happened at the peak of the 2000 when we declined into 03 from 07 to 09. It peaked in 2021 down to 2023. So this is the year when likely we're going to see some consolidation, I think. We really want to be aware and probably properly diversify and not just put all our eggs in one basket into technology like many have gotten used to in recent years. There's plenty of areas within energy that are working quite well. Of course, Iran tension is part of that. Materials, commodities, emerging markets that look actually quite great. Looking at the LATAM space with what's happening in Brazil and Mexico and even areas like China that are gradually starting to rally again. So I think investors really need to consider stepping out of technology to some extent this year and letting it reset, and then it'll be time to buy again by the third quarter.
How does the economic data factor into this? We are not going to get that jobs report that we had anticipated for non-farm payrolls on Friday, but we did get the private sector read this morning on ADP. Did show job growth in the tens of thousands, but still shy of economists' estimates.
Yeah, this is honestly less about economic data. The job growth and really what you look at with regards to U.S. economic data has been far better than what we've seen in Europe. And so, GDP growth potentially could be 4.5% to 5.5% this year. Inflation is coming down. We're sort of in a Goldilocks period with regards to that. The real key is, does Warsh focus on inflation, what he said he's going to do, versus employment? We know that there have been layoffs, but yet the unemployment rate is still largely fairly low at 4.5%. It hasn't really started to skyrocket yet. And companies are holding, retaining people. They're not necessarily laying off in broad fashion. We've seen the quits rate, of course, be maintained at a fairly decent level. I'm not an economist by trade. I would just say that for me, looking at earnings and the economy, those likely aren't the reasons why stock markets are going to experience turbulence. It usually happens for other reasons. And so long-term interest rates starting to radically turn higher is something investors want to be paying attention to. The yield curve has been steepening in recent months. The dollar, of course, has plunged, which the administration argues they don't want, but yet that'll certainly help with regards to the deficit.
How does precious metal volatility factor into what you're watching when it comes to the charts?
It's just really one more area of something that has had a parabolic move that is now starting to come back to life. I sense that it's not going to be an investment as much as it will be a trade. My analysis in recent days suggested that metals can bounce, and I do expect that, but I don't think we get back to the highs, and I think we're probably going to see further volatility to the downside. The one concern about metals is that rates are starting to escalate on the long end. They still have a lot of great things going for them. We still have a real spending problem. We see deficits out of control. This normally is a great time for metals at a time when Warsh probably will stick to cutting twice this year. So Fed rate cuts are also a conducive environment for the metals. But we've seen a lot of volatility in a short period of time. I don't sense that that means that we immediately go back to highs. We probably are going to have much more of a choppy trading range where we rally over the next week or two. We pull back probably into March. We pull back to new lows, under monthly lows for gold and silver. That would probably be the time to consider buying them for the period of between summer into the fall for a potential move back to new highs then. So much more of a volatile trading range than what we're used to in recent years.
Mark Newton, head of technical strategy at Fundstrat, joining me in studio. Mark, thanks as always.
Thanks, Kristen.